Welcome to the Hollow Point Trading Weekend Market Brief, focusing on the 42x problem, picks, shovels, and the real cost of AI. We'll explore CAPE at 42x, NVDA rotation, the software turn, and the AI bill. Our method has three pillars. Macro considers valuation and where we are in the cycle. Fundamental looks at earnings and who profits from the AI build-out. Technical focuses on price, data, and flows. This brief covers all three on a quietly rotating market. This edition includes a look at macro and valuation, the real cost of AI, picks and shovels, the software rotation, price, data and flows, and cross-asset dynamics. We begin with Pillar 1, macro and valuation. The key question is where we are in the cycle, and what the crowd is actually paying for it. The Shiller CAPE ratio, which smooths inflation-adjusted earnings over a decade, is currently at approximately 42x. This is a level only reached once before, during the 2000 dot-com peak. This tool also flags stretched conditions before the 2007 housing top. Looking at CAPE at great market tops, we see 42x near the historical high of 44x. Remember, expensive is not a sell signal, but CAPE signals that the downside math is ugly once the market turns. We're watching a potential setup. Could CAPE trace a long-run trend line, push to a fresh higher high, tap it, and then turn? We consider both a bullish and a bearish path based on current conditions. The forward PE map shows a fat tail of names already trading at 20 to 35 times forward earnings. This high valuation is the ammunition needed to keep the index holding its ground. SpaceX's reported IPO multiple is around 50x, making it likely the largest IPO ever and potentially fast-tracked into the S&P. Mega IPOs often see initial hype followed by a fade, so watching this is key, but trading it immediately is not necessary. Moving to Pillar 2, the real cost of AI. We are asking who actually makes money from the build-out, and who is simply paying the bill. There is a rumor of a $500 million single-month token spend by one firm, reportedly due to uncapped employee usage. While unconfirmed, the sheer size illustrates the accelerating trajectory of AI consumption costs. Enterprises are reportedly blowing through annual token budgets in months. This leads to broken forecasts, as AI usage scales with adoption, not fixed seat counts. Margins are migrating as compute costs shift to the customer's P&L, leading to behavior changes like usage governance to cap revenue stories. The core issue is a shift from the old world of predictable SaaS flat seats, which finance loved, to the new world of consumption. Pay per token means the meter never stops. The risk is pushback. Companies might hire more staff instead of incurring escalating consumption bills. The awkward question is whether hyperscalers are earning their massive AI capital expenditures. The Financial Times suggests most big spenders may be running negative on current AI returns, with Amazon being a possible exception. CapEx is today's book, while revenue is tomorrow's promise. The market is now paying for delivered ROI, not just the story. NVDA is a prime example. Meanwhile, mega IPOs like SpaceX draw liquidity and attention, temporarily energizing the market. These two factors are the main levers for the 2026 tape. We move to Pillar 3, picks and shovels. Remember the core concept. When the strongest stock stops responding to good news, pay attention. This suggests a re-evaluation of market leadership is underway. Despite NVIDIA delivering great earnings and upgrades everywhere, the stock sold the news and began lagging the rest of the semiconductor group. When the leader can't hold a beat, the picks and shovels trade is actively rebalancing. What is the moat for these leaders? If competitors close the gap and a hardware glut appears, the premium on the leader compresses fast. We see competition where rivals catch up, substitution with custom silicon, and supply issues turning scarcity into commodity pricing. A major supply threat is a reported hardware and RAM-focused IPO coming out of China. If this new capacity can mass produce, the scarcity premium in hardware names will leak. Commoditization is the typical end for every hardware cycle. The backbone check shows that semis versus the S&P is choppy but hasn't broken yet. As long as semis lead the index, the AI backbone of this market is intact. A clean break of this ratio is the first critical warning sign. We observe big prints under the surface, notably a massive transaction in Micron, its second largest ever. Qualcomm also logged a large print. When memory and connectivity names light up, the tape is positioning for something significant. Now to Pillar 1V, the software rotation. The money leaving the picks and shovels trade has to go somewhere. We look at where this capital is rotating next. Microsoft saw the biggest trade on record by volume, printing right as the market hit its first supply layer. We previously flagged software's heavy volume, showing that accumulation appears in the flows before the headlines. Software experienced a plus 6% single-session move, energy normally seen from a chip name. The forward PE for Microsoft had already slipped below its 10-year average. The technical action did the talking. React, don't predict. Software is back above its 200-day moving average, a constructive sign historically associated with positive forward returns. The thesis shifts. High-moat software may be helped by AI first rather than hurt by it. We are watching a divergence in correlation. Software is pulling away while Bitcoin lags. These two have historically traded together. Correlations eventually expire, so keep the core thesis and nuance the edges. The Microsoft chart is now widely recognized as a quote, indicating a common trade. The danger is that everyone plans to sell at the same top. The edge is always earlier, getting in on accumulation, not the last third of the move. We move to Pillar V, price, data, and flows. We are only interested in what is reflected in price action, data, and flows. This focuses on current market structure across key indices. The S&P 500 and NASDAQ maintain a structure of higher highs and higher lows, suggesting a positive trend with broad participation. However, the caveat is NVDA weakening while the index makes new highs, a crack that should be respected. For key levels on the US 500, we're watching 7,600 as a major call wall and overhead resistance, and 7,540 as the first dynamic support. The line that defines the trend is 7,500, with 7,000 being the crowd's most struck put wall. The S&P is boxed in by options positioning. There is a dominant call wall at 7,600 and a heavily struck put wall at 7,000. Until price breaks one side, dealers will likely pin the market within this range. For the NASDAQ 100, the call wall or upside resistance cluster is concentrated around 7,300 to 7,350. The most struck downside hedge is the put wall in the 7,000 strike zone. QQQ mirrors this same call wall behavior. In single-name options, TSLA sees 450 as the most struck put magnet, with puts building at 430. NVDA has puts stacking at 210 and 200 across longer-dated strikes, reflecting its post-earnings struggle. Next, Pillar 6, cross-asset. We'll examine the entire board, looking at what's moving, what's coiled, and what shows late-cycle characteristics. The dollar index, DXY, has been range-bound for about 12 months. This inactivity removes a major swing factor from risk assets. A range this long typically ends in a violent resolution, so watch for a decisive break. US 2Y and 10Y yields are ticking lower, a calm, orderly move. JGB yields are softer but still elevated. The stress gauge for the bond complex is USD JPY, pushing toward 160. Financials are weak and stuck in a consolidation trap. No higher highs is a late cycle tell. Conversely, broad value funds are grinding up, suggesting participation is widening even as the leaders wobble. Despite some scares, the consumer is still spending, which reads as risk on. However, much of this spending is debt-funded. This debt could become a problem quickly if any market instability occurs, representing a key tail risk. Gold ran into technical supply resistance. A clean close above the daily 200 mA near 4,400 would suggest a strong base is forming, ideally with calm higher highs and higher lows. Crude is coiled, held between conflicting political pressures, staying range-bound. A close back above 98 would flip the short-term tape and suggest a technical turn is underway. Bitcoin is testing support at 40.41, a level that is held before. It is still carving lower lows and lower highs. Flows showed the largest dark pool sweep printed about a week ago. The VIX is currently low, fitting the seasonal calendar for a midterm year. Volatility tends to spike into the July-August window, presenting opportunities for traders. To summarize, valuation is stretched, defining future return math. Leadership is quietly rotating from hardware into software. The real cost of AI is the swing factor, and the clock points to increased volatility this summer. Adopt an abundance mindset. React, don't predict. Get in on the first third of a move, not the last. When volatility returns, treat it as opportunity, not threat. Keep the core thesis and nuance the edges. Thank you for joining the HollowPoint Trading Weekend Brief. You can find more of our content on YouTube, X, Discord, and Substack, or visit hollowpointtrading.com.